dollar faces years of depreciation. Periods of risk aversion can support the dollar for a short time. The factors that contributed to the dollar's rise since the lows of 2011 began to reverse. Movement down was important. Investors are worried about selling the dollar after a 10% drop against the euro in 3 months. As long as the global risk appetite is calm, the dollar is set to fall further in the next few quarters. Currency markets react to changes in key variables and, like all markets, pull with momentum. The dollar is sensitive to global risk sentiment. A cautious and anxious environment tends to strengthen the dollar as portfolio streams are sent back to the United States. The long dollar position is a hedge against equity portfolio, high-yield bonds, and other risky assets. Risk appetite has increased since the end of March, and the dollar has weakened. Risk aversion attacks are set to occur. COVID-19 remains a source of uncertainty. US-China tensions may flare up in the next few months, and the US elections could be alarming for investors. Unlike other asset prices resulting from the rate of change of economic variables, such as growth, currencies reflect relative economic relationships between countries. In 2018, the dollar appreciated thanks to higher US returns and higher US returns than Europeans and Japanese. These interest rate differentials have fueled the dollar over the past decade. Thus, investors buy US bonds for higher returns compared to Japanese or euro-denominated bonds. Other investors adjust their money protections based on the cost resulting from interest rate differentials. While the spreads were still in favor of the dollar, the spread has narrowed since March. The difference between 10-year US Treasury bonds and German bonds of similar maturity fell from 2.3% earlier this year to less than 1.1%. The Federal Reserve is putting the finishing touches to its updated monetary policy framework. The upcoming Jackson Hole Virtual Symposium will provide investors with an indication of how far the Fed is going to allow inflation to move beyond the 2% target to catch up with the low inflation rates of recent years. A high inflation tolerance and suggestions that policy rates will stay close to zero until unemployment drops to pre-pandemic levels will further weaken the dollar. High fiscal deficits have an impact on currencies. Since the beginning of the pandemic, budget deficits have increased in most countries. In the past, high returns accompanied high deficits, but central bank action in this crisis prevented any increase in returns. Direct bonds purchases and central bank comments kept US yields low. Europe, Japan, and many other countries also posted large deficits, but prospects for a new US fiscal package and the ongoing concerted Fed stance are worrying for foreign investors. To get some future return from financing US government spending, foreigners may need some incentives through a higher risk premium. Despite prolonged negotiations, a $1 trillion financial package will be passed. Europe and Japan are also increasing their financial spending. The European Central Bank and the Bank of Japan increased monetary policy, easing through aggressive asset purchases. The big news is that the European Commission's bond issuance program has a €750 billion deal. The emerging EU bond market could become an important and liquid alternative to US Treasuries. In addition, it can support the value of the euro that suffers from Brexit and persistent concerns about the cohesion of the Union. The market welcomed the announcement and the euro was significantly stronger. Another factor that weakens the dollar is the uncertainty over the November elections. If electoral stresses trigger a broader period of risk aversion, the dollar will be a net beneficiary for a short time. The dollar started a multi-year depreciation against other major currencies, low and diminishing returns, increasing fiscal deficit, and less risk aversion should continue. More structural factors such as international reserve managers diversifying currencies or paying more of the world trade in euro or renminbi will have only a small effect on currencies. Many investors have lowered their dollar positions, so there will be no dollar collapse. Conversely, if volatility hits the markets again, there will be a gradual decline, punctuated by examples of strengthening. But the truth is that some kind of economic miracle will literally be required to avoid a recession. Unfortunately, when a new recession begins, it may not result in the way recessions normally do. The US government owes $26.8 trillion. We are in the middle of one of the largest stock market bubbles in history. And our planet is getting more and more unstable every day. So even though Trump is in the White House and Obama is gone, there can be no doubt that a catastrophic economic crisis could erupt literally at any moment. I continue to encourage my listeners to do their best to prepare, because those who are prepared will have the best chance to successfully dodge the next. Unfortunately, many people out there seem to believe that all our problems somehow evaporating just because Donald Trump is currently living in the White House. This is absolutely not true, and we need to pray for guidance and wisdom for Trump and his team. We are preparing to tackle the great challenges our country faces.
Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.